Hello guys. Another thing that you should think deeply when you do investing is the risk. Because whatever you do, either you do day trading, you do scalping, you do swing trading, you do position trading, or you do investing, everything has a price. It means how much you are going to uh, take as risk. Okay, so I will just give you an idea about the risk, because if you should never forget about the risk, because you will be either making money or losing money. There is no what we call investment that it is safe. Okay, there is no, that's some people they say you invest and you don't, and you are always good. There is no, it doesn't exist. Okay, except when the market is going up, this is another thing. Okay, but you lose everything when there is um, a bad year. Okay, let's go and just explain something to you about the risk. How much risk is in investing? To explain this, okay, let's say XYZ. This is the company that you search, and this is you want to invest in it. Okay. Now, XYZ, you bought it. Let's say $20. This is the point where you bought it here. $20. You are, let's say, in 2001. Just an example, okay? The stock has been going up, going down, going up, okay? Let's say going down like this. And now the stock is $2. So 2000, let's say today $2 is 2018 in January. We are in January 2018. So here, as you can see, this is the day where you bought, and this is where you are now. How much risk is in investing? It depends on you, on how many years you are going to stay, and is there a change in the fundamentals of this company, or competition, or the price, or the industry itself. There are a lot of things that makes risk. There are some people who risk the whole money. Let's say you put 20K in this company, and then now you have only 2,000 because you lost. This company is not making that good. The stock was $20, it goes to $2, and you lost everything. Okay? So the risk is big. Why? Because when you invest, you are going to stay years and to see. It means years. You are not going to stay 1 week or 2 or 3. So you are going to stay the whole investment time. It could be 1 year, 2 years, 5 years, 10 years, 20 years, 30 years. Okay? So you should decide when you do 1 year, you should see where you are. Is the company making money, or is it losing money? If it is losing money, is it because of the company itself, or about the industry, or what is it the problem? Why you are losing money? And if you think that this company is losing money because of the management, because of the technology, because of something else, you should try to decide to exit this investment and find another investment. Because if you continue to lose until you get $2, from 20,000 you get 2, it's a big risk. Okay? Now, this is one thing I'm speaking about. Now, let's go to the other thing, which is a lot of people, when they want to invest, they use what we call mutual funds and ETFs. Now, other people, they use stocks. So, what's the difference? This is the question. What's the difference about between these two? Okay, mutual funds and ETFs. Now, mutual funds, what are they? It's a collection of stocks. And there is a manager who manages this. It means he buys and he sells. There is a manager. This is mutual funds. Now, what is ETFs? ETFs, it is just a stock. It is like a stock that tracks an index. Just an example. So here, stock that tracks an index, there is no manager. It's automatic. It means if the index goes up, the ETFs goes up. If the ETFs goes down, the index is going down. So it is just it follows the index. Now, most of the people, especially when you go to financial advisor, he will ask you to do mutual funds or ETFs or bonds because they give interest rate. So this is because they don't want you to risk a lot. So the risk is minimum. The bad thing about this, of the mutual funds and ETFs, because it follows or it tracks an index, which is a combination of stocks, or mutual fund is a collection of stocks. It means that the growth is slow, up or down. So I will just take this and make that the growth. It means, in general, it is slow. Your money goes slowly. Let's say you put 20,000. Let's say next year you will find it 22,000. Very, very slow. But you put 20,000 in a stock or stocks. Let's say it goes to 40,000 because you bought a stock that it doubled. So you see that stocks have more risk. They have more risk than these mutual funds or ETFs or bonds. Three things that all these guys are buying. So here it is slowly, and we have less risk. But when we say less risk, it doesn't mean that there is no risk. There is risk of losing money. But here we have more risk and we have more profits. So for the risk here, what you should do, especially if you buy stocks, if you are young, this is better for you. If you are young, let's say 20 years, 30 years, 40 years, it means you are still working and you are far away from the retirement. Stocks is better for you, but it's better not. Just give you an idea, is never buy one thing. Okay, so you should have what we call diversification. Diversification. Now, what does it mean? It means, let's say you buy a stock number one, let's say energy sector. Second, let's say technology. Okay. Number three, let's say financial. Number four, let's say it is utilities. Okay, it means you should never put all your money. You should diversify. Now you told me, okay, for this diversification, you told me, for example, the mutual funds, ETFs, they are diversified by themselves. They are diversified, so you don't need to diversify more because they are diversified, and there is a manager who changes the stocks here. They are always changed of mutual fund and ETF. They are always changed. But here, you should, if you buy stocks, understand that you should do diversification. But this diversification, it doesn't mean that you have less risk. Okay? You always have bigger risk with stocks than mutual funds. Okay? If someone succeeds with stocks, okay, young guys will better succeed with stocks than mutual funds and ETFs. Those, most of the time, if you are buying those, your risk is very, very minimum. You have a risk, but it is minimum. But understand this fact that I am telling you right now. This is a new thing I'm telling you right now. If there is, for example, a bad year like 2008, most of the mutual funds, ETFs, stocks, they go 50% down. Okay? So in years that are bad, your risk for mutual funds and ETFs will be the same as in stocks, depending on how much things is going here and there. So understand that in bad years, the market is affected by this downtrend, and you can lose a lot of money. Some people, they try to, when there is bad year like 2008, they move their money and they put them in bonds, or they put them in cash. Okay, so they put them in cash with a saving account or whatever, or they put them with bonds because they give interest rate like 2% or 5% or 6%. Okay, this is what the people do. So it's up to you what you want to do, but understand that a bad year will eat up all your profits. So either you change your money, or you take them out and you put them in cash, or in money, or in money markets, as they say, or what we call CDs or something, or you put them in bonds or other stuff, or you take all your money from the market and you put in a safe place until the market changes. Okay, so let's see, for example, let's say Dow Jones. I will just give you an example. Okay, Dow Jones by years, and we'll try to see. Okay, let's take this. Move. Okay, let's go to the month to see better. Okay. Now here is, as you can see, from where the market begins to go down is from November 2007. November 2007 is the beginning of the downtrend. Now, where it stops? It stops in February 2009. Okay? So it's like 1 year. Now this 1 year, okay? This 1 year, which is a downtrend, which is a bad year for the market, okay? All the stocks in this year have suffered. All the stocks, major stocks, okay? Let's say I give you an example with Walmart, just an example, okay? Let's say here, nine, we say 8. So the stock was going down even before the thing. So yes, it was going down even before of the crisis. But we see November, the stock was going up, expecting. So let's say yes, Bank of America in November, you see it goes so bad. The stock was 48 in 2009. In March it was $6. You see how big on some stocks, how big can affect, okay, how big is for Bank of America at that time, how it much lost, okay? So here let's give you the November. Yes, so the stock was $46.13 in 30 of November 2007. This is the area that we are searching for. From 46 it goes to 6. Oh, it goes here to $3.95. Let's say it's $4. So if you own only one stock, let's say you own Bank of America, and you have money as $46, and then it goes back to be $4, you see that you have lost all your money. And even after many years, 2009 until now, the stock is 31. It goes so good, but still it needs many years, like 9 years, and still it is not where it was in, for example, in 2006, where the stock was $53. Okay, this is just to show you where bad things come to the market. Some companies, some stocks, they lose a lot, and some they go bankrupt. And this is what has happened. Okay. So this is for Bank of America, as I showed you. So from this date, 30 November 2007, the stock was 46. It goes to $3.95 in February 2009. Okay, until now this company or this bank, it doesn't do that good, although it goes up and it is now 31, but it was 46. So from all these years, it means 9 years, and still it has problems. Okay, so this is just to show you that in bad years things can happen, and a lot of stocks, a lot of companies, they lose a lot. So that's why people, they move their money and they don't stay that long in a bad year. They go to bonds, they go to buy other things, Okay, so they don't want just to leave their money there and they see it disappearing day by day. That's why if you ask me, are you investing? I say no, I'm not investing. I'm not just doing swing trading. It means I don't want to go with the big risk where you put your money and you see in some stocks are going down and you just watch them for 1 year, 2 years, 3 years. What if these stocks doesn't go up more anymore? What if these companies they have true problems? Okay? And this, I'm telling you, there is no one who tells you about this news. The news you get them when you can't change anything. For example, if a company gets bankrupt, it's over. Okay, you can do nothing. Your money is gone. Some people have put. There are a lot of people they put hundreds of $1,000s, millions of dollars in a companies that they were good, but in the years they become bad. But they don't took their money out, and they see that there are bad news. They see each month, each 6 months, each 1 year, bad news, but they keep because there are some people they say executives of this company they say we are good. It's just 1 year or two which has bad luck, but we will be coming back. But they don't tell you the truth, and there are a lot of examples in the stock market and what did happen, and people, investors lose a lot of money. So you should be aware of all this stuff before you invest in this money in these companies. Thank you very much.